Hey everyone, Weston Nakamura from Real Vision in Tokyo. I want to just quickly address central banks this week, this first week of November. Now notice that I said central banks, plural, not central bank. The US Federal Reserve and the FOMC is not the only central bank in the world. First of all, it's not the only central bank in the world, for those who didn't know. Second of all, it's not the only central bank that is having a policy meeting this week. Three major central banks that do have policy meetings this week, which is the Fed, the Bank of England, and the RBA, the Reserve Bank of Australia. It's always this unanimous notion of the Fed is like the central bank that always matters above and beyond anything else, so much so that no other central banks matter, which is just plain stupid. And why? Well, I know why. Yes, I'm aware that the United States economy is the largest and most powerful in the world. Yes, I'm aware that the United States capital markets are the largest and most deep in the world. Yes, the US dollar is the world's reserve currency. I get it. I get why they're in focus. That doesn't mean that other central banks and their actions do not impact markets. There are many people out there who are solely focused on the Fed. They completely misinterpret markets and market drivers. This happened, oh god, when was it? Back in, just last month, the last round of meetings. You know, the exact same setup, actually, in terms of, like, scheduling chronology. You had the Fed, and then you had the Bank of England a day later. I actually had recorded a video, but it was kind of a test run, so it never actually aired on YouTube. But I will show you that video because I will show you the commentary that I was making at the time. Because there was this huge move in global sovereign rates, and it was attributed to the Fed, and that is a very stupid thing to do because there was another central bank called the Bank of England that actually that move should have been attributed to. So here's me from a few weeks ago in the last policy meetings. It is Monday, September 27th, right after Japan cash close. Let's not forget that there were 12 central banks that reported. Let's not forget that only one of those central banks was the Federal Reserve. The Federal Reserve was arguably the least consequential of all of them relative to how much importance and focus it was given, relative to what kind of market impact it actually had, which was none. If you actually look at 1:59 p.m. Eastern time, okay, so that's 60 seconds before the Fed actually released their policy. If you look at a snapshot of U.S. markets from then and then until 4 p.m. market close, okay, so that would be after the policy is released and after Chair Powell gives his press conference and all of that. S&P E-minis were at 43.86, 1 minute before the Fed. 43.86 versus 43.85 at 4 p.m. close. VIX, 21 before, 21 after. 10-year U.S. Treasury, 1.309, 1.307. And yes, in between, each one had their respective algo swing up and down, as always. But when all said and done, it was largely unchanged markets, and it remained that way, a half a day, a good amount of time. So now, obviously, I'm not saying that the September FOMC was not important. It certainly was. Nor am I saying it should take too much from an immediate market reaction alone, because some policy events reveal their full market implications over time and indirectly. But there are also moments when central banks and their actions or the messages or the lack thereof swift and immediate market impacts. And when that happens, those should not go ignored, nor should they be attributed to something else. It was the Bank of England who crushed the G4 bond markets and sent back-end yields surging on, a 2 sigma move. And you can see exactly at the moment when the Bank of England came out, and you can see what happened to markets. Now, what I will say, however, is that I don't want to give Bank of England all the credit, because the global bond markets are like any other financial asset. They're susceptible to FOMO. In fact, they're arguably one of the most susceptible to FOMO. The Bank of England merely triggered a selling frenzy, because right now you have just divided market of people who believe in long-term inflation is here to stay, and no, it's not here to stay. There are storm clouds ahead. Whatever it is, people that think that yields are going to go to 10% and minus 10%. So when you see price movement in either direction, people that were not positioned how they wanted to be positioned, they jump in. People that were kind of shaky about their position because there's half of the other side that's making all these arguments, they're going to bail out of their positions. So what moves the bond market is the bond market. Prices move prices. And it just so happened to be that the Bank of England was the match that lit the kerosene-soaked barnyard on fire. It doesn't even matter what that charred match is after the fact. But let's not pretend that, this was the Fed and fund managers took a day to process or something, and then all of a sudden, they all simultaneously woke up, and then they all simultaneously had this delayed reaction and suddenly decided to sell the treasury. That's the narrative that I hear. When I hear things like that, what it does is, even if I don't know what moved the market, it's informative to me because I know that, okay, other people are just as clueless as I am. Because what you're saying, if you think that, sound travels slower coming out of Jay Powell's mouth than it does in the rest of the physical world, and it takes 24 hours to reach fund managers' ears to get them. If you think that that's, I don't know how else you would explain a delay of reaction from professional fund managers, but if you think that that's the reason that they all simultaneously did that, that's a sign of, I don't know why the market is moving, but I have to say something. For whatever reason, I have to give an explanation. That's what that is. So in this case, it is the Bank of England. Okay, so you know what causes that kind of thinking, or lack of thinking, I guess? That lack of realization of there are other central banks out there that can move markets? It comes from starting from the mentality, all eyes on the Fed. If your mentality going in is all eyes on the Fed, then your eyes will only be on the Fed. And so anything that happens, you're going to attribute to the Fed. Markets don't react with a 24-hour delay. Can't believe I actually said that out loud. Okay, so for this week, we have a very similar setup. We have the FOMC on Wednesday, we have the Bank of England on Thursday. And before that, we have the Reserve Bank of Australia, the RBA. Okay, so you recall what I said about the Bank of England and the UK gilt market, which moved global sovereign yields, and not the Fed and the Treasury market? This is what I'm talking about. That is when FOMC released their policy. And that is when the Bank of England came out with their policy. I'm going to ask a very, very difficult question. Look at the two lines. When did the market move? On the yellow one or the white one? Clearly, it was the Bank of England that was the trigger catalyst. Unless you want to argue somehow that it was not only the Fed, but it was also not the Bank of England. If you'd like to argue this, please send me a video in response. I would love to hear that. And I'm actually not being sarcastic. I would really love to hear that. But as far as I'm concerned, it seems pretty obvious. So this is something that we need to keep in mind, because on November 3rd at 2 p.m. Eastern, the FOMC will be releasing their policy. They are going to talk about tapering, and they're not going to raise rates in a few days. Now, the Bank of England is calling for this to be a live meeting, but the markets are still kind of split on this. So either way, there's a good proportion of the market positioned wrong. So you're probably going to get fireworks either way, in one direction or another. If and when the FOMC and Jay Powell comes out and starts talking about specifics about tapering and when he's going to taper and how much they're going to taper and what rate they're going to do it and when they're going to be looking at potentially increasing rates, or how they're not going to be tying in the act of tapering with rate hikes or whatever the hell it is, right? And you get the knee-jerk move in S&P and in 10-year yields and the dollar versus the euro, the yen, the whatever. You get the algo move, but then 24 hours later, if the Bank of England lifts rates and starts talking even more rate hikes coming or tapering their bond buying or whatever it is, and markets move, let's not attribute that to the Fed as some delayed reaction. And I know it's going to happen ahead of time, and that's why I'm calling it out now. And I will call it out after the fact as well. Like, don't misattribute catalyst and, market moving forces and triggers. You have to identify what actually is moving markets rather than falsely identifying what's not. Just because the US Treasury market's the quote-unquote largest, most liquid market in the world doesn't mean that it's not susceptible to other gigantic sovereign rate markets. And at the end of the day, people buy and sell treasuries because people are buying and selling treasuries. So let's learn from this and not apply that same nonsense to this. Now, I'm not saying that UK yields lead US yields, although they sometimes can or do, or that they have influence over them. What I'm saying is that they both have influence over each other. So, on to the RBA, the Reserve Bank of Australia. Again, people are already attributing this to the Fed. So you really have to keep an eye on what the RBA does. Now, it also might be a situation where the RBA does or doesn't do something. Like they could scrap yield curve control, but the market reaction might not come forth yet because there are other central banks. So if you see a muted reaction after the RBA, that doesn't mean that was it for the RBA reaction. You have to wait for not just the Fed, you have to wait for the Bank of England. After the Bank of England, you might actually see pent-up residual flows in the front end of the Aussie curve just suddenly explode, and therefore exacerbating the reaction. So watch the Bank of England and UK gilts for the long end, watch the RBA for the front end, and look, at the end of the day, if you just really don't give a shit about this, and you're just like, the fuck do I care about the Bank of England or the RBA and their yield curve control and all that kind of thing? I'm long Shiba Inu. Well, there's a chart of Shiba Inu for you. I don't know, maybe you should care. Probably wouldn't hurt to watch the front end of these yield curves, because they seem to give a hint as to what Shiba Inu is going to do. Or not.